12th of December 2012. Yes, there's no getting away from it, the number of the day today is 12. So it's fitting perhaps that the benchmark Greek bond yield has a 12 handle, falling below 13% today for the first time since April last year. I'm Jamie McGeever and this is today's Market Pulse. So then, 12, 12, 12. The next time we have a similar date will be 01/01/01, the 1st of January 2101. That's not for another 8 to 8 years, and as Deutsche Bank put it this morning, hopefully by then there will have been progress in the fiscal cliff talks. Well, the fiscal cliff uncertainty, no barrier to risk appetite today. Stocks and commodities are up, and in FX, dollar-yen is at a fresh 8-month high. For more on that, I'm joined by Jeremy Bolton, FX analyst at IFR. Jeremy, we've just almost touched 83 today on dollar-yen. What's the next level?
Hi, Jamie. Well, the next level is around 83.30.40. Basically, that's a couple of prior highs in March and April of this year. And there are also several option barriers on the way up between 83, the figure, and 83.50 that are being targeted at the moment. Mainly, today's moves have been based around the attempts to trigger an option barrier at 83. There's not really any fundamental shift behind it. They're just basically in the pursuit of stocks above the level, and currently they've failed to take it out. So we're kind of looking at a market that's got even longer at the top.
Well, you mentioned the market being long. I mean, the latest IMM data suggests that positioning is its most skewed in favour of long yen positions for over 5 years. Surely the upside is, it's not going to go that much higher.
It suggests that we're going to struggle to go up, but having said that, the record for yen shorts is more than double what the yen shorts were in the IMM data. I mean, we're talking about the yen carry trade of 2007, which we know what happened to that. It dramatically fell apart, so people would fear the same move. But it also suggests that yen shorts could grow substantially before they'll have that kind of same material drag on dollar yen. Having said that, I myself feel that the top side is restricted, and of course a dollar yen long play at this level, directly ahead of a Fed meeting where the emphasis is on further easing, is obviously not a good idea. You may be better off looking for carry trade funding with another currency, particularly dollars, obviously, if they're going to ease somewhat.
As you suggested there, we've been here before. In 2007, that carry trade collapsed. History suggests you should never bet against a currency with a current account surplus, especially one with a safe haven like the yen.
That's true. Obviously, I mean, the focus on current account surpluses has kind of gone off the agenda at the moment because people are perceiving that the ECB has done enough to offset any risks out of Europe, and people are taking on a lot more pro-risk positions. The equity markets are obviously bid on the back of that. Greece is sort of being pushed to one side at the moment, and the focus is very much on low volatility in markets, and low volatility in markets supports the carry trade, and the carry trade is obviously going to be funded by a certain number of currencies, but ideal amongst them obviously Swiss, yen and the dollar. But they all obviously offer better liquidity, very low rates, negative in terms of Switzerland, but obviously yen is very popular because people are expecting a huge kind of emphasis or drive from the government and central bank, or more the government in mid-December to push the yen lower. But how they can do that, is a huge question. I mean, they're facing a significant hurdle themselves. I personally think that, the trade is a buy rumour, sell fact. So we've done the buy rumour. How much more the buy rumour's got to go? I don't think that much. The highs of March were in the low 84s, 85, significant levels psychologically. And obviously the upside for me is limited. I would rather look towards a fade above 83 or around 83 than looking to get long. OK, Jeremy, thank you very much. Another month, another surprise. The UK labour market continues to defy gravity, with another set of strong numbers. The claimant count falls by 3,000, the broader ILO jobless measure drops by 82,000 to just over 2.5 million, and the number of people in work hits a record high. It's not all good news though. Average weekly earnings rise by just 1.8% in the 3 months to October. With inflation running at 2.7%, that means that even those in work may not be in the mood to spend. Inditex, the star of today's corporate earnings. Earlier, the world's biggest clothing retailer beat forecasts with a 27% jump in 9-month net profit. It also predicted growth of up to 10% over the next few years. That's not enough to drive the stock higher though, with Inditex down around 0.5%. That vindicates Credit Suisse analysts who said earlier this week that a 64% rise so far this year means the stock is already fairly priced. That's all from us for now, but join us every day at this time to look at what's moving on markets and why. I'm Jamie McGeever. This is Reuters.